listening to the Daily Gold Podcast, covering precious metals, the junior mining sector, and global capital markets for intelligent investors. Now, here is your host, Jordan Roy-Byrne.
Hey, everybody. Welcome back to another episode of the Daily Gold Podcast. Thank you so much for joining us today. With me is returning guest. He's one of our favorites, Vince Lanci with Echo Bay Partners. He writes the GoldFix as well. And Vince, we were talking about what we should talk about while we record here. And, you've been writing more about silver recently, and I don't want to exactly have to pin you down to make definitive statements, but you've been writing more about silver, and I'm kind of deducing that your long-term thoughts are getting a lot more positive. I don't know what you think about the short-term, but I mentioned to you one thing I've noticed is that we've seen a divergence in the market. Silver made its low the first day of September. It's almost been 2 months since then, and during that time, gold broke below 1675. Silver did not make a new low since then. And even, gold selling off today, it's not that far away from testing its low again. And silver is, fairly comfortably above that low. I'm not saying it can't go down and retest it. But so we're seeing this positive technical divergence with silver. I guess my two questions are, how does that factor into your current analysis? And then in addition to that, what is your current analysis with respect to silver?
Yeah, right. Okay, first of all, Jordan, thank you for having me back, and I'm excited to be here because the timing when you call me is like the timing is really good for this because there's a lot of stuff I've been writing out. I've been very silver oriented lately, last say week and a half, 2 weeks, and the timing is good because this is gold related, and I know your focus is gold. But they're both precious metals. Okay, so why don't I start with the technical aspect of it first, because that's going to be pretty cut and dry, hopefully for me. Okay, the first part is and I'm talking so I'm putting my trader hat on right now, and when someone says to me, "Gold made a new low, but silver did not," what do you think? And the choices are, and you didn't say that to me, but that's what I'm thinking. The choices are, well, if gold made a new low and silver did not, then either gold is a buy or silver is a sell, right? If gold made a new low and silver did not, then silver is due or, gold is due to bounce. And I'm not sure how these work in precious metals, but, it's like Dow theory, and it's like if one makes a low and the other doesn't, you have a positive divergence. If it happens at an extreme, you can call a top. So I would think that, and I'm not a technician, but I would think that when something makes a significant low, not a low during the day or a low during the week, over a time period, and its sister asset does not, then you would have to say that that's a possible turning point or inflection point. And kind of like an RSI that's oversold, I guess. You don't want to be short. You don't want to be long, but you don't want to be short if the market rallies. So it's kind of like I'm a buyer of rallies, not a seller of dips from that point of view. Okay, so to answer you directly, so now that we didn't talk about this off the air, so I'm thinking about it now. So my choices are buy gold because it's too cheap relative to silver, or sell silver because it's too expensive relative to gold. In the short term, we're talking about a short-term concept here. And the answer is I would buy gold as opposed to sell silver. Now, before everyone says, oh, of course, because you're a metals guy. No, that's not the case. Sometimes I would say buy gold and sell silver. But I'm going to tell you why I would buy gold and sell silver. Not sell silver, just buy gold. First of all, my bias is to be long. So that's why I'm buying. But I have sold before, and I will sell. And I sell short as well. But the knife that allows me to buy gold instead of sell silver is because of the things that I'm seeing on the silver side. So bear with me. The silver buying is CTAs covering shorts. And I've talked about that before here, I think. And the silver buying is paper-based. And the silver buying is short covering based. And silver is a smaller market, and it's a thinner market, and eventually it may be delayed. You can go on and on and on. It's like silver is delayed, it'll catch up to gold, and those are all valid points. But the silver EFP, which is the spot market versus the COMEX futures market, is backwardated. That tells me that while this buying is shorts covering, they're covering because the physical demand is not going away. Well, what does physical demand in silver have to do with gold? Well, it doesn't directly, and I'll tell you why we have to be a little bit nervous about that too. But it means that in general, precious metals are bid for on the physical side. And while it won't happen overnight, the physical buying eventually overwhelms the paper selling. Not today, not tomorrow, and certainly not in the next 6 months in gold, and certainly not in the next 6 months in oil. Those two I look at together. Silver is a different animal. Why is that? Because the U.S. government and the West in general seek to stabilize assets that Russia and the East make money off of at lower prices. And as long as we are the strongest currency, we're going to get, reserve currency, we're going to continue to do that. So when you take gold making a new low and silver not, and you take, well, silver's not making a new low. Why is silver not making a new low? Oh, it's just shorts covering. You should sell. I'm like, okay, why are the shorts covering? The shorts are covering because the physical demand on the silver side it seems insatiable. And I'm not talking about the headlines, about the, silver coin premium. That stuff's all real. Don't get me wrong. But I don't look at that as anything more than noise by salesmen trying to get you to buy more. And those bids stay there until they're not there. But the physical demand is freaking relentless. And you don't spoof a market higher on 1 or 2 days. This is structural. And this has been my contention for some time now, that there's a structural supply deficit in silver. And right now it's being massaged by paper silver being weak so people can buy physical silver from weak hands that have to sell it. So people that are panicking are selling, slow panic, and they're buying. So when you take that physical silver thing as it is and you apply it to the complex, you say, well, if this continues, it will eventually spill over to gold. Is it spilling over to gold? Well, not in price, but there's kind of little premiums that I'm seeing in gold now as well. So if that continues, if this is a snowball or a juggernaut that's slowly gaining momentum, what's happening in silver will happen in gold. So I'm a buyer of gold, not a seller of silver. If you told me I had to do a trade right now, I would be a buyer of gold, and I can only do one. I can't do both. I would be a buyer of gold and not a seller of silver. And here's why, additionally to what I just said. If I'm wrong and silver gold correlation, if you're wrong too, right? Because I'm sure you're familiar, you're friendly to the market as well. If we're wrong about buying gold, then silver still has a very good chance of exploding and gold can go nowhere. Why? Because if you remember back in 97 when Buffett bought, the first leg in silver higher, gold rallied. And the second leg in silver higher, gold didn't. And that was how you knew that there was something wrong, and it was very silver specific. So the answer is I'll buy gold and I'll risk silver not going up. I think silver has too much buying to not go up, and it will drag gold up. The caveat to all that is this. Anybody over the age of 50 knows that silver doesn't lead gold in the long term. Silver follows gold in macro and secular moves. I'm bullish because of fear or inflation, or I just want to have my money in gold. They put their money in gold first, and a GLD or some small bars, and silver tracks gold because silver becomes the undervalued asset. However, in short-term moves, and that's what I'm focused on here, in short-term move, meaning 6 months is short-term. In short-term macroeconomic moves, silver leads gold because it's cheaper and people throw their money into it. So let's say I buy one gold and one silver. Well, one gold's not going to move the market. One silver will move the market. So silver will bubble before gold gets going in the short term. And in secular moves, which is what we haven't started it yet, but we're going to, in secular bigger picture moves, gold leads. In fact, you probably see this more than I do, because I'm told that in bigger moves, which also happen at the end of the year, we're about to enter buy season for gold, you will see that money go into gold stocks first, because so many people have their money on the equity side. I don't know. But does that answer the first part? I'd be a buyer of gold, not a seller of silver.
Yes, but I do want to follow up on the physical demand in silver, because we've been hearing about this for 20 years, and I don't know if you can track it, but I mean, because the silver bugs, that's what they say, you know, the physical market is going to overwhelm the paper market or the futures market. I mean, can we look and see like the premiums in the physical market? I mean, are you familiar with any chart where you look the premium spike and then that marks certain lows in silver? I guess I'm just looking is there a way to analyze this via data and get more get some clarity? Because I mean the physical demand, I mean, is that going to start to overwhelm the market in 20 years or, you know, 1 year or 2 years? I guess I know it's hard to answer.
No, if it's in 20 years, I'll be dead, right? If it's in 20 years, I'll be dead. So we need to keep it shorter term if we're right. Okay, so that's a really good question, because it factors in not just the validity of the whole physical overwhelming paper thing, but you're also asking me about the time frame, which is extremely reasonable considering that we probably all, on some level, feel duped by people that are a little bit more charlatan than analyst. Okay, let me try and tackle that. First, I'll tell you. I'll give you. Hopefully, it's tightly worded, but it'll be soup to nuts on the physical side. I don't care about the coins. Not yet. I mean, I do, but I don't care about the coins. I don't care about anything else that's said to me by a person. Coin premiums, some idiot telling me they're going fast. It's all salesmen, you know. You want the far red, you want the undercoating. I don't care about that nonsense, right? What I care about is manifestations of opinion in actions and behavior. What does that mean? Well, when a coin dealer says, I will sell you, when this all started, right, about a year ago, right, I will sell you Eagles at $5 over. Okay. I'm like, I don't care. What price will you buy the Eagles from me at? And they're always saying spot. I'm like, well, that's a $5 bid ask. I'll buy it at spot and I'll sell it to you $5 over. That's not a market that's bid. That's a supplier who's gouging because he knows that you're a captive retail buyer. It's no different than a car salesman who says the price is 35, or let's say 50. The price is 50 because you come in telling him you're buying a car. You call a coin guy up and say, I'm buying coins. What's your price? Duh. He's going to say the highest price he can. Okay, you should do like a trader and like I would do. I go into a coin dealer, or I don't do a lot of coins, but I go into a coin guy and I go, okay, what's your price? It's $5 over spot. Okay, I want to sell my coins. What will you pay for them? And the answer is always spot. Now, if anybody remembers 2017 or so, APMEX and the bigger dealers and Kitco, they were selling silver and gold at spot. We'll just stay with silver here because that's what we're focusing on in terms of the physical aspect of it. You were at one point you were able to buy silver at spot and they were giving you extra coins or something like that. It was crazy. And they were obviously in a cash crunch and they had more coins than what they had to do with, knew what to do with. And so they were getting rid of inventory. Okay, so that was survival for them. So now I see I'll buy it at spot and I'll sell it at $5 over. And I go, that's greed. Like, that's not a physical squeeze. And I believe that to be true. And I researched it. And the answer was I was right. The dealers were trying to charge 5 over, and they weren't willing to pay more than spot because, and I could be wrong, but I don't think I am, because what do you call them? The fabricators, the refiners, the guys who stamped the coins were raising their premiums to the retailers, right? So, instead of calling it APMEX or Kitco, just call it, Kitmex, so one of those companies, right? So one of those type of companies. So they were not willing to buy above spot because they didn't have a lot of cash. And they were selling at $5 over because the refiners, this is my opinion, but it's well researched, were gouging them a little bit. Why were the refiners gouging them? Remember during COVID, 2020, refiners, here's what happened. COVID hit. Northern Italy shut down. There's some big refiners there, some big fabricators, some big coin blank makers there. And they shut down and they came back. And, the labor aspect of making the coin, basically because of COVID was on strike. So they came back and they asked for higher premiums and the demand built up and they got higher premiums and the dealers got screwed because they were paying, more than they had to, but they wouldn't buy it at spot from you because the refiners were just gouging. The refiners had the extra inventory and they were holding it back. They were playing the keep it off the market thing, the Giffen good thing. Then after a year of that, I saw I would go into the coin dealer, hypothetically, where I would do it online, and I'd say, "Where are you now?" Like the last thing I purchased was Royal Canadian Mint, Maples at 450 over, and it was an expensive deal at the time, but Eagles were like 7 or 8 over. I'm like, that's ridiculous. It's stupid, right? So I didn't care. So I'm like, you know what? It's silver. I'll buy myself a smelter and I'll make them Eagles if I have to. So I just bought them and then I was watching silver drop and I repriced them and the guy was still spot at 450 over. The market's $1 lower. The guy was still spot at 450 over. I wasn't looking at price anymore. I was looking at premium for my trigger. And then silver drops and we start seeing this EFP happen where the spot is trading over the US future. I go, that's interesting. And I've seen that before and it doesn't last very long, but it is an indication that there's no physical silver available at that moment. That's more important to me than what a dealer is charging. So I went back to a dealer. I forget who the dealer was, but I said, I can buy coins at 450. It wasn't 450. It was 550. I can buy coins at 550 over RCM. I can buy coins at 550 over. What price will you buy them from me at? And usually they say spot, and maybe they'll pay a little bit more. He goes, I'll pay 350 over. And I went, shit. He's actually paying over spot. It's not the sell side that matters when you're talking to a dealer. It's the price that he will buy them from you at that matters for me in my trading. And so I immediately said, okay, I don't have a relationship with where I can actually talk to him. So I talked to another guy and I said, what's going on? He goes, well, all those refiners that were price gouging us are running out of coins. And so we'll buy them back now. And I go, okay. And there's all kinds of games that can be played here to spoof it higher as well. So I went back and I just bought some SLV. I didn't buy any coins, I bought some SLV. And time moves forward, and I see that the physical EFP is now a future in my mind. When the market rallies, when the market drops, so we'll just pick two prices. The market goes to $18 in silver. The EFP spot goes, let's say, a nickel over futures. I'm like, that's not normal. It is a sign of physical tightness. So let's connect the dots. You have, when the market drops, there's a physical buyer that keeps coming back. When the market rallies, the physical buyer does not chase because the EFP doesn't keep going. But when the market drops back down, the spread reflects, once again, physical demand, even though there's paper selling in the US. And it's not physical demand at the dealer who's like saying, oh, I'm going to charge you $10 over. It's physical demand from the London spot market. I go, okay, well, it keeps coming back. It's become a living, breathing thing. And I go, well, that's a sign that someone is siphoning the silver off the market. And lo and behold, for the 6 months after I started to see that, you start seeing the silver get pulled down at a faster and faster rate. Or not a faster rate, a regular and more regular rate. It was, very systematic. It's someone is taking the silver out of the market. So that's the information. Excuse me, I have seasonal allergies. So that's the information. And I go, all right, so when will this translate into price? Which is essentially what I think your listeners want to hear. Okay, we've been hearing this physical story for 20 years, to paraphrase you, right? And Vince, that's a cool story, but it's just another story. When is it going to happen? I'm not telling you to buy it now. I'm not telling you to buy it tomorrow. I'm telling you this, and this is why I seem very bullish. I'm telling you that all the things that are happening on the path to higher price are happening. And I laid out a path 5 years ago. This is what's going to happen. If this, and this happen in succession, then the price will eventually go up. And this, and this have happened. This, meaning the price of silver is so low, there's no one mining silver for silver anymore. It's either a waste product or something else, or there's no silver out there, right? There will be a consolidation in the silver, and this is happening in gold too. There'll be a consolidation in the industry where a couple fraudulent dealers go out of business. You remember that, 2018 or so. And you'll see the price stay suppressed. And the next thing, there will be less long speculators in the market. The market will be repressed or suppressed, or however you want to look at it, underinvested. The next thing, physical will become scarce and the EFP will start to trade over. Okay, that's it. That's where we are in the whole path of what happened with Buffett. Like, we're at that. Buffett did what's going on right now in a 6 month period. He did 5 years and 6 months. So now I look at this. So to answer your question, like, is it going to happen tomorrow? I don't know. This is the honest answer. I don't know. But if it does happen tomorrow, it won't be the end. It'll be the beginning. And hear me out. I'm not saying it's going to go up. It's going to keep going up. I'm saying when it happens the first time, the real first time, when it gets above $30, $35, you're going to see someone step in and slam it really, really hard. So to anyone who's asking about short, medium, long term, let me just first give you the behavior that's probably going to happen. When silver starts to move higher, the trigger for that will be more east-west divergence, a shortage of collateral, and something triggering it. And there's more information coming out that that's starting to happen, although I don't believe in it until it actually happens. We'll talk about that another time, I guess. So that's happening. All right. So what will happen once it starts getting going? Once it starts getting going, it's going to go up and it's going to lose its shit again, and it's going to get put in its place, just like it got put in its place in February. A couple of years ago. It's going to happen again if it happens that way. And that'll be the sign, in my opinion, this time when you start getting higher highs and higher lows. The market will get slammed and people will start buying it. So and then you'll have a multi-year, 10-year, 15-year bull scenario. Now, I just want to say something to your listeners. I don't represent a coin company. I don't represent a metal dealer. I'm not talking my portfolio. The only thing I'm looking for, if you want to give me money, is you give me money for my knowledge, and that's what the newsletter is about. I have my own investments. The reason I'm reasonably passionate about this is because the middle class and middleman have been getting screwed for decades by the market structure of the government, which is another whole conversation we can have. And I put that in a couple of posts, put the one on Zero Hedge about that. So anyway, back to the point. Now that I've given you my layout, I don't know what's going to happen, but it's going to go up, and then it's going to go down, and then it's going to become a real market. Very similar to what happened in gold after 1999. It went up, $300, right? When that whole Y2K thing, it went down, and then GLD started, and you had a relentless march of gold higher over a decade. And that's what's going to happen in silver. It won't be so relentless as it'll be more volatile, but that's what's going to happen in silver. So what type of time frame is really, I think, what people care about? Is it going to happen tomorrow? No. If you think it's going to happen tomorrow, you've got a problem, right? It's going to happen in 6 months. It could, but I think it'll be going 5 to 10 years from now. I don't think it's something you want to sell your investment on the first time we go to $50. I do think if you're a trader, you definitely want to sell $50 so you can buy it back at 20, because that's what's going to happen. It'll happen like that, which it may not be too helpful for people. So I'll give you what my plan is. And I think this plan that I'm about to give you is also relevant for first-time investors who want to put money in. I mean, do you think that will be helpful?
Yeah, absolutely.
Okay, cool. All right. So generally speaking, when I have an idea that I like, and this is an idea that I like, and I don't like it from I have trading signals, right? I have a trading signal that works on the hourly, the 4 hour, the day, the week, the month. Most of it's hourly and 4 hourly, right? So I'll be long for a day or short for a day, and I will trade the market. I don't view the precious metals as a religion. But, I understand them better than most, I believe. And it's certainly better than the Keynesian types who think it's a piece of shit, because they don't understand. They've been living for 40 years between 1980 and 2020 in a bubble of monetary ease. And that's over, folks. It's over. From 2020 to 2040, 2050, I don't know. It could be like one of those crazy conjure type things. But we're going to have tight monetary policy and easy fiscal policy. It's going to happen in general. And we'll talk about the Fed and the pivot stuff, because I know we want to talk about that, right? And talk about them in a minute. But I'm saying we're entering, all right, people, it's the 70s. Yeah, it could be the 70s. How about this? If it's the 70s, it's 1971, not 1979. Okay, we're going to have, if you look at the inflation chart between 70 and 80, you had a massive dip in 76 back to like 2-3%. I forget what the number is, but it's ridiculous. And everyone thought everything was done. And then it went to ridiculous levels. So we're not even done with the early part of the 70s yet, in my opinion. So I also think that we're actually like more in the late 60s. We're just ending the war in Vietnam.
I completely agree with you, by the way. There's a lot of similarities to the 68 to 70 period and what we've seen in the last year or two. Gold stocks and silver peaked in the late 60s, like a year or two before inflation peaked, just like we saw this time. And that was the first time. That was the first time in a generation the Fed actually had to tighten, and the first time in a generation they saw inflation. I mean, historically, that's like if you think about it, that's the biggest Fed tightening ever to that point was that cycle.
I didn't know that. Okay, that's interesting. I didn't know that.
I haven't verified that, but that's something I think. Unless they
let me corroborate that.
Yeah, go ahead.
I didn't look at charts on that, but let me corroborate that. See, when the Fed right before we went off the gold standard, one of the main reasons we went off the gold standard is because we were having our gold taken from us. And so we had to monetize our debt. So we had to pay for Korea, we had to pay for Vietnam, we had to pay for the liberalization of our, you had to pay for, rights, education, the growing of the social safety net. That's a good word for it. The social safety net that had to grow after Vietnam and all that. We had to pay for that. And 1971 was part of that. We went off of the gold standard. Okay. So I didn't know that it paralleled in the chart, but for me, it all started right after Vietnam, which was around 60, Vietnam was, I guess, technically over in 75, but we started bailing out of there and losing in 1971 or 1972. So if you're saying it's 68, then that makes me feel good, because I don't look at things like you do. And it's always good if not delusional, to have your opinion corroborated by a discipline that you don't use. So I'm not a technician or a statistician in that respect. And if you're telling me that the Fed raised the most they ever had at that point in 68, that's pretty significant.
I think they did because, I mean, in the late 20s, I'd have to pull up the chart. I think it was pretty significant, the tightening that they did. Because silver went down 50%. The gold stocks went down 60% in that period.
There you go.
And if you look at, of course, the market, you had the gold was fixed in price. But if you look at gold, or if you look at silver in real terms, in the late 60s or 1970,
right?
It's like where it was in 1930, or relative to the S&P, or maybe a little bit below. So, I mean, I was talking about this in a video. People were probably thinking then, like, what the hell is going on? We had this huge burst in inflation, and silver, it's like in real terms, is like at an all-time low practically. And we're seeing the same thing today. You look at silver against the S&P or silver against anything, it's in the toilet, despite the fact that, we had this huge burst in inflation, and, silver didn't, went up for 4 months. So I don't want to get too off track, but that's and it's good to me.
And everything we're saying right now.
Yeah, it's good to me that you come to that same conclusion, like you said, using another entirely different discipline.
And everything we're saying about silver in this part of the conversation is definitely about gold. I mean, it's the same thing, in that respect. So now we got to put some time frames on it, and to put time frames on it, I'm having a hard time with that. So, admittedly, right? I'm not saying, it's going up tomorrow, right? So to circle back, it's like I can't put the time frame on it that I want to. I have to be honest. I mean, you can't tell. You can't tell me that when the Fed's going to fold or nobody knows. I mean, a chart will give you levels. A chart's actually the best thing to have right now. A good chartist is the best thing to have right now, because a good chartist is at least going to say to you, this is what happened last time this happened, and if it happens again, I wouldn't get in the way. Like, that's what a good chartist is telling you, and anyone else who's telling you, well, because, like, here's a salesman, right? Because the premiums are going so high, silver's going to go up. No, that's not true. I can tell you why in another conversation. Because the EFP is over, silver's going up. Well, this is me. Yeah, I want to believe you. I really, really want to believe you. And I'm certainly bullish, but don't tell me it's definitely going up. You don't know what's going on behind the scenes. It could be something to do with leases being unwound on SLV. Who the hell knows, All right, so back to the whole time frame. Because I can't really give a proper time frame, look, there's two ways to assess risk when you're looking at a target, right? And it's either time frame or quantity. So if I had no money, or I had the first $300 I ever had, and I wanted to put it to work in precious metals, this goes for silver or gold right now. It really does. I would, and this is actually, I'm doing something like this now. I would call it a 1/3 trade, right? 1/3, 1/3, 1/3. I'm using the word trade, but I don't mean trade. I mean investment, right? Okay, so the first 1/3, I have money. It's sitting there and it's ready to go into something, and I want to put it to work. Well, 1/3 of it goes into the market right now. That's it. $100 goes into gold. What's the mix? Let's say we're working with gold here, right? What's the mix? Well, whatever you're comfortable with. But let's just be simple about it. You go 1/3 into an ETF, 1/3 into physical, and 1/3 into miners. Based on your preference, you change those ratios. Oh, I like to have it in my hand. Fine. So 2/3 into physical, but you better put the other third into miners, because that's how you get leverage. Someone says, oh, I love miners, I hate physical. Fine, put 2/3 into miners, but you better put 1/3 into physical, because you want to have some sort of a base if one of those miners turns out to be an idiot. So that's the first $100. The first $100 goes into the market today, right now, and I've done that. And to be honest with you, it went into ETFs. But that's what I'm doing, right? What I'm doing is I'm doing the $300, 100, but I'm doing them in different assets. So I put the $100 into ETFs because I want exposure to a bull move in all three asset classes, in all asset types, simpler right now. Boom. I'm sticking my toe in the water. I want to see how it feels. Okay. The next $100, the second 1/3, happens when, and if I'm wrong, we'll talk about that. But if I'm right, this is what's going to happen, right? As I said it before, silver or gold doesn't matter, right? All right. Gold has a rally, $100 or $200 rally. Oh, hold on. I gotta mute this. How do I do that? It's the sleep thing, right? Oh, come on, people. All right, I got it. Okay, so how do I do that? So the market, I already said that. The market, I have the $100 in, right? And the market goes up. How do I feel when the market goes up? I probably feel miserable because I didn't buy enough. And then I probably feel good because I bought some. But I'm a little bit greedy and I feel miserable. I'm not going to buy it when it goes up. I have a plan. It's stapled to my forehead. I'm not buying it when it goes up because this isn't short-term shit. This is long-term shit. And if I'm wrong and it keeps going up, well, fine. At least I got 1/3 in. But I believe that after the first spike, whatever it is, from here to 30, from here to 35, from here to 50, from here to 22, I don't know. There's going to be I believe, now this is opinion, right? This is pure opinion, but it's based on previous experience. I believe there will be a pushback. For every action, there's an equal opposite reaction. And that pushback will push the market to some ridiculous low. It could be coincident with a depressionary, the Fed not pivoting. It could be some catastrophe on the credit side. It could be some, global recession type of thing. I don't know, but it could be JP Morgan saying silver sucks, and then it goes down again. But there'll be a pushback. And the pushback, I don't know where, I don't know how it'll come, but it'll come because when you push the first time, you get a pushback. And that pushback, the market will drop. And the market will drop from this new high to some price. I don't know what that price will be. But on that pullback, I will buy the second 1/3. And the second 1/3 in this will also be 1/3, 1/3, 1/3. It'll be 1/3 SL, 1/3 GLD, 1/3 miners. Just assume I know miners. I don't, but it's what I would say if I was you. 1/3 GLD, 1/3 miners, 1/3 physical, right? And then you've got the final third, right? The final third is in your pocket. And the final third is your insurance. Why? Because because remember, I bought the dip. I didn't buy strength. If it keeps going down, I'm going to feel like shit, right? I'm going to feel horrible. But I will look at that money that I didn't spend and I'll say, or invest, I'll say, well, at least I still have bullets left to use. And when I decide on the next collapsing dip, now we're talking about Great Depression shit, that $100, that last third, I'm probably going to put that into physical because I know physical. Someone else may put it into miners because that's a good company. It's undervalued. The management is great. This is the market. That might be, if you know miners, that's the way to go. If you know physical, that's the way to go. But I will not put it in an ETF down there. I will not put it in an ETF because that's where things just go belly up or bankrupt or something like that because they start raiding the vault because it's so cheap. Okay, so the other scenario is the market. I buy the first 100 today. I buy the second 100 on the first dip, which should come after the first rally, right? And the third 100 I buy on the second dip. Well, suppose we don't get that second dip. We don't get that second dip, we're going to rally, right? So let's just say we rally after the first dip and the market rallies. That last 100, now I'm in the money on all my investments. That last 100 becomes speculative money for me, right? Then I buy strength. Then I play around. That last 100 will be speculative frenzy, but only when the first 200 are in the money. That's what I want to do. That's what I'm going to do. And that's what I'm best at doing in blending really long term with really short term. Now, I'll throw a couple years at you, a couple dates at you, but your listeners know they're smart. It doesn't mean shit, but I'll give it to you. I'll give it to you, but it could happen. This like music. Now I want to go back to silver again because that's what I'm focused on with this EFP thing. Like, for example, if the EFP starts trading over in gold, forget about it. Then you've got a big problem. The EFP trading over in silver and not in gold reminds me of what happened in 94 and 2011. When people want to buy precious metals, they want to buy gold. But people who are huge and want to buy precious metals that want to buy gold, that even the Fed even smells that they're cornering the market, will step on that immediately. And so you end up going to silver, which is not as watched by the Fed. So that's why silver EFP goes over and gold doesn't. At least that's my opinion. But it's based on 94, 97, 2011. That's how it works. So staying with silver again, if this silver could happen, please, this is not an actionable statement. Silver could start this whole process tomorrow, right? It might not start this process for 6 months, but it won't end. I can promise you this. It won't, and this is easy for me to promise because you won't be talking to me 20 years from now, right? But I believe it because my purchases are for my children in college, right? And they'll be in college starting now through the next 7 years. I believe within 10 years, the silver market will be, and gold definitely, but gold will be much less of a trader's vehicle, will be much, much higher. And it'll be basing at $30 when the first thing is over. When the first thing is over, silver goes to $36 and they tamp it down again and it goes to 20 or 25 or who knows, maybe $4. But the next leg higher is going to be one of those Elliott Wave 3 of 3 things. And it's going to, it's going to go to 150. It's going to stabilize. And it's going to coincide with a reset, with a shortage of collateral, with a Far East monetization of silver, which I think the East is buying silver through India. I really do. And by the way, that's bullish for gold, not because they're related, but because you can't accumulate gold without the Fed finding out about it. You can't accumulate silver. And I'm jumping around a little bit, but to answer your question, the question I think people care the most about, probably your listeners, and you've told me that because you care about them, is I have $300. I'm putting $100 to work tomorrow. I'm putting $100 to work on a violent dip, and the last $100 I hold in my pocket for an even bigger dip or to mess around with if I'm right and the market goes up. That's it. That's what I'm doing. What's the time frame on that? Well, now is the first time frame, and that's been executed. The second time frame is on a dip, and that dip for me, right? Because of the way I do things, I'm going to buy physical on a dip, and I'll buy futures on a rally. That's how I work, right? So if we get a dip, I'm going to take delivery, right? I'll take delivery. It won't be coins. It'll be something bigger. And once I get that, if we go lower, then I'll kind of feel okay. It's like, at least I have the silver, I have the gold. It's okay. It'll be a mix of those two things. And the third thing is that last 1/3, I might never get to put it to work. And that'll be the happiest day of my life if silver and gold, if gold goes to 3,000 and silver goes to $80 and I'm underinvested, I'm underinvested by 1/3. I've got my money in the market though, Anyway, so I hope that convoluted thing helps. $300, 1/3 now, 1/3 on the next big dip, preferably after a big rally, right? Pushback. And the other 1/3 in my pocket to mess around with when the other 2/3 are in the money.
Okay. Yeah. Thank you so much for all that. Can I ask you one more thing before I let you go?
Sure.
One more thing we can.
Sure.
Now I agree with you that fiscal stimulus. I mean, we're obviously moving into that. It's going to be everything's going to be fiscally driven. The Fed's going to fight back and have to, hike interest rates, looking out over the next 5 or 10 years. But to play devil's advocate, looking out at next year, I mean, I personally think we're going to be in a recession. The Fed's going to have to ease eventually. It's a question of how soon, but I think reasonably before the end of next year, they're going to be easing policy in some way. I think to me that is more of a driver in the next 6 to 9 months than the fiscal side, because you're going to be looking at a divided government, most likely. That's what the percentages are saying. And if you're the GOP, unless it's a severe recession, you can just wait a couple years and say, yeah, we're in a recession. We're just going to vote against any spending, and it's going to help.
Right, and you can blame it on the Democrats, right? You can blame it on the Democrats for the first 2 years. You're right.
Yeah,
about
so
that.
I think what could happen next year, at least for the next 12 or 18 months, is you might have one more last gasp of the Fed easing policy before the real handoff takes place. I mean, I could be wrong, but just looking at the next year, I think it's more likely the Fed's going to ease that. You get fiscal stimulus when you're going to have a divided government.
Right. Okay. All right. So first of all, let me just say I agree with you, because normally I'm right. Normally I'm confident of my intermediate term and short term, and less confident in my really long term. Right now, I'm really confident in my really long term and less confident in my intermediate term. So I'll put some dates on that for people. So my long term is 10 years. My intermediate term is 2 to 4 years, and my 1 to 3 years, I should say. And my short term is like 2 weeks or 1 week. But to your point, right? Let me see if I want to make sure I've digested this right. I'm not really sure. Okay, so we've got a government that's potentially going to be split after the midterms. 1. 2, we've got a Fed that is fighting inflation even while the Department of Treasury, the fiscal side, is easing, which brings us to the concept of the pivot, and we'll come back to that in a second. And 3, even if I'm right about this long-term secular change about the Fed being tight and the fiscal side being easy, is there a good chance that we're going to have a Fed easing in the next year? That's pretty much what you were implying, right?
Yes, and I just think Fed easing is more likely only in the next year than fiscal stimulus.
No, I'm agreeing with you. I'm agreeing with you, right? I can tell you that over the next 5 years, the Fed will be tight, but in the next 6 months, they could be easy. Which brings us kind of to like 2 diverging points that I, in an uncowardly way, I hope, agree with both. You've got one side, which is the Fed's going to pivot side. That's your zero hedge side. The Fed's going to pivot, something's going to break, and they will pivot, and they will be pressured to do it. And the people who disagree with that, and I won't say the people that are going to say, the idiots that disagree with that are the people who say the Fed's fighting inflation, the Fed doesn't care, the Keynesian says nothing's going to break, or they'll just bail it out. Those people, in my opinion, are morons, right? What zero hedge is talking about is not that something will break. What zero hedge is talking about is what they're saying is that even if the Fed does not want to ease, the political pressure will get too massively huge for them to ease. What are those political pressures? How do they manifest? Well, the economic pressures manifest with the GDP dropping, unemployment going up. And the Fed is prepared in some way, shape, or form to not give in to that, because they said they're not going to give in to that. But the political pressures are the White House knocking on your door saying, not saying I'm not going to get reelected, but saying, this, that, and the other thing, whatever levers they have to push. It's like, you have to be on board with us. We're seeing, I don't know what you're seeing, Mr. Fed, but we're seeing this, and this. You bet the political pressures will become enormous on Powell. All right, so that's zero hedge, the zero hedge group's mindset. And mind you, I am in the zero hedge group. The Powell's going to ease. I'm sorry, Powell's going to pivot. Well, let's define pivot. Pivot means Pivot right now means lower rates, going from raising to lowering overnight. That's what the word pivot means, doing a turnaround. Okay? What's probably going to happen is he's going to pause. He could pivot if there's something that breaks overnight, but he's probably going to pause. And then maybe the pivot comes later on. But to your point, not raising rates 75 basis points and surprising people by only raising them 25 basis points will be treated like a pivot. Gold will rally, stocks will rally more, crypto will probably rally, but in the end, it'll go back to what it was. But just to stay with the zero hedge concept right now, something will break. This is zero hedge. Something will break and the Fed will pivot. And even if nothing technically breaks, there will be political pressures like you've never seen on Powell to pivot. And they're right, because I've studied what happened with Burns before Volcker. And what happened with Burns was he was pressured by Nixon to ease, to keep it easy, to chase inflation, to not get on top of it with real rates. He admitted that in a speech, which is like on our site somewhere. It's like it's a long PDF, but I tortured myself and read it, and I wrote a post about it. So, and he admitted all this to Volcker in a speech. Anyway, to stay with that. So zero hedge is right. And now you got this relatively new, the Fed's not going to pivot thing. And I'm not talking about what you read in the mainstream media. I'm not talking about, just people that are just being dogmatic about it. I'm talking about people who study the ideological splits in government, which is kind of what you said about divided government. Tom Luongo talks about that. And he mentioned it like 2 months ago to me. And it really rang true, not because of who said it. He's a reputable guy and he's a good guy. And I think he's very scientific in his approach. But because what he said was basically a financial behavioral overlap of what I've been studying about the ideology of neo-Keynesianism versus, say, Austrian, or woke versus practical, however you want to look at it. And he drew a line that said, and he did it by just saying who benefits, cui bono, right? Who benefits if the Fed eases? Not the Fed, because the Fed isn't owned by the government. The Fed is their own entity. The Fed is putting themselves out of business, like the oil companies that are being asked to print more oil so that we can get off of oil. You follow? Like it's very similar. It's an ideological split. And Tom, who's saying that the Fed will not ease, he may not be saying they will not ease, but he's saying they're not being wimps about it, is because he sees the split in the world very similarly to I do, the way I do. That is, you've got I look at it as neo-Keynesian. I'm not even getting liberal conservative, just economically. Neo-Keynesians have a way of looking at things. I'm not going to get into it now, right? And then the flip side of that, the other extreme is, say, Austrians, right? And what it really comes down to is how you view capitalism. Neo-Keynesians, money isn't an issue. We can print as much as we want. It's all about value and value that we bring to the market. Well, on the left side, well, not left or right, but on one side, you've got the neo-Keynesians. That's Europe, that's Davos, and that's a portion of the U.S. government on the Democratic side. Not all Democrats, but a portion of the Democratic side. Let's say it's the progressive MMT types in the Democrat side. Now, I don't see Biden as one of those, but I do see him as being manipulated by those because he's older and he wants to go out with a bang and he thinks he's probably doing some sort of a New Deal. So now you've got on that side, you've got the people who want easy money, will take care of inflation by giving people more money. This ridiculous economics theory, okay? And who's opposing them? Well, who's opposing them is ironically, and please don't send me hate mail on this, but a Marxian, pragmatic, materialist mentality that says, no, this is this. This is real. You can't make this go away by wishing it away. And those people are represented by Austrian economists, not Marxist at all, but Austrian economists. And believe it or not, some of the U.S. banks, not Bank of America, I see them as liberal, neo-Keynesian. JP Morgan is a capitalistic bank. They are conservative. They have no problem with fleecing you time and time again, but they do not want the sheep to be skinned. And JP Morgan and banks like them, Goldman Sachs, a couple other banks, but those are the two big ones. Those, and Morgan Stanley, those are the banks that influence the Fed the most. And the Fed right now, they believe, and Tom Luongo believes, will not ease because they're protecting their industry. And incidentally, not coincidentally, but incidentally, they're protecting America. They're saying America first. We want to get our inflation under control, and then we will just pillage the rest of the world. Whereas the Biden administration and the European counterparts are saying, you know what, we're just going to take everything down to the same level and start a reset at a lower level. And so the one side is zero hedge saying pivot's coming. And then Tom Luongo is saying, no, pivot's being resisted. And I agree with Tom as well. So that's my WIMP answer. I agree with zero hedge and I agree with Tom. And here's why I agree with both of them. And I predicted this, although it's not in writing. I predicted this and I wrote about it emphatically 2 weeks ago. The government has already pivoted. The Fed hasn't pivoted, but Yellen, who runs the Treasury, pivoted. So to your point, fiscal largesse does not get felt in the market immediately. It takes years, right? Fed monetary easing gets factored into the market almost instantaneously. What did Yellen do last week, 2 weeks ago? On one day, it's not the Fed, it's Yellen. They opened the Fed window to Europe, to the Swiss National Bank, which went from $0 to $10 billion, which they reallocated. That's easing. That's pivoting, right? And then the next day on Friday, what did she say? She said, we're exploring. What the hell does that mean? We're exploring if we can buy back treasuries, if that will help liquidity. Well, guess what? That's QE. She's doing QE, right? And the other thing she said was, I can't remember exactly what it was, but it was like that. And it's in one of my posts. But she did three things that were monetary easing. And so I asked myself, and I did some more reading, like, what is she doing? Well, but I believe it's probably more than a metaphor, that they knocked on Powell's door and said, dude, you've got to ease. We've got problems in Europe, Credit Suisse. We've got to keep Ukraine afloat. We can't have Germany become friends with Russia. You've got to take care of Europe. And Powell's like, nope, fuck you. USA first. We got to get our inflation under control. I don't care. So he's Monroe Doctrine, Fortress America, and they're like, fuck, you've got to ease. He's like, no, I'm not. It's like, you know what? I'll take care of it. I'll do this, this, and this. And that's what she did. That's what she did. And there's going to be more of that. And eventually, when that doesn't work, I'm not saying it won't work, but if that doesn't work fast enough, remember, fiscal takes longer, then they knock on his door again and says, dude, we've got to get you to ease. And that's already started to happen because I don't know how to say his name, but the Wall Street Journal reporter, Tim Rouse, their leaker now.
Something like that. I think you got it.
He's their leaker now, and he's already saying that there's going to be language in the next report that's going to say we're going to ease 75 basis points now, but it'll be 50 after that. So that is their version of that's Powell compromising. So to answer your now that I've given you a billion words on background to answer your question, I think if you had to bet, you don't want to bet on this, but if you had to bet, I think and this is my tinfoil hat now. All the logic aside. If I were in charge of the data at the government and I had a vested interest in keeping the Democrats or the current administration in power, the status quo, I would change. I mean this. I would delay bad data until after the election. Absolutely. Because if the bad data comes after the election and the Democrats win, they won. If the bad data comes out after the election and Democrats lost, well, they're going to blame the Republicans 3 months from now. That's how it works. And I'm not making that up. I've done a study of GDP and GDP revisions going back over years before midterm elections. And it's inevitably, during Obama's administration, it's higher going into the election and then revised lower afterwards. And we're on that path again. It's happening again. It's not because they're Dems, it's because they're in power. And that's what's going on right now. So my answer is, if I had to handicap the next 6 months, I'd say it's a 50-50 shot. And that's a pretty big shot that GDP prints negative again after the election, and unemployment starts to rocket up right after the election, and then the Fed has cover to pivot because they've held their own through the election and they can walk out with a smile. So what does pivot mean after the election? It means instead of 75 basis points, it's 50. So how does that translate into our markets? I'll tell you, I really wish stocks would crater now so we can buy gold confidently. Like, I would love to see stocks crater, gold go down, and silver remain firm, because then I would just be buying more gold, right, as a spec trade. I don't like the fact that stocks are going up. You and I talked about this, right? Stocks at 4,000, the S&P, that stinks, because then the Fed can say, I don't have to pivot. Then the Fed can say, I can raise 75 basis points. The Fed can keep raising 75 basis points if these idiots out there keep thinking he's going to pivot. It's like a self-fulfilling prophecy. So, long story short, I'd be a buyer of bad news economically between now and the I'm sorry, I'd be a buyer of good news dips between now and the administration. When good news comes out and the stock market craters and gold craters, I'd buy it. I'd be a buyer of bad news after the election. Bad news comes out, stock market rallies, because I'd be buying strength. So I think the Fed's going to pivot. I think the Fed's going to pivot, and it's going to be after November. How's that? 3 words. I just shut up. After November, Jordan.
That's I guess if I could do a very quick follow-up, the pivot you're saying is just they're going to pause?
Well, that's the thing. I mean, pivot literally means going from hiking to easing. I think.
Oh, okay. I didn't want to put words in your mouth, but I see what you're saying.
No. Pivot literally means hiking to easing. But these guys are going to try and redefine what pivot means. Like Biden's going to, like Powell's going to say, I'm not going to pivot, but I'm going to go from 75 to 50 to 25. I'm going to ease out of the hiking. And the fiscal stuff, by the way, will handle the braking. If something breaks, right, they'll fix fiscally, right? That's what they'll do, right? And then you'll start to see the Biden administration say, we got the Fed to stop raising rates. They've pivoted off of their inflation fears, something like that. But it's not a pivot by the definition of the word. They're not pivoting by the definition, although Zero Hedge really thinks that something's going to break and the Fed will have to pivot. I think maybe, but.
Yeah, I look at it as it's like a 2-part situation. You have they're no longer hiking, then they're cutting. So to me, it's like a 2-part pivot.
Yeah, exactly. Which, by the way, just to be technical, that's not a pivot. A pivot is when you turn 180. And a pivot, I'm not being technical. Pivot means when there's a crash or something happens, the Fed goes from a hiking cycle, which has happened, believe me, every hiking cycle we've had for the last 5 years, something breaks and they go from hiking to easing. Overnight, they do it. I don't think it's going to happen overnight this time, which means it's not a pivot, technically. So I think you're right. I think they're going to go sideways, back off, and then start easing. Or you go to the Volcker era. Raise 75 points, lower 25. Raise 75 points, lower 25. Raise 5%, lower 2%. I mean, why do people think we have to have a reversal on a dime? I mean, why do people think that? Why can't we just go sideways for a little bit? People are spoiled. Stock people are spoiled, Jordan.
They are. Well, I mean, we'll see what happens if the market and the economy tank.
Yeah, there's that final third. There's you and me going like this. Okay, we've got our last third of that money to go in. Do I buy gold with it, or do I burn it in the fireplace to stay warm? You know what I mean? Like, who the hell knows at that point?
All right.
But my next call, my last silver coin purchase, to give you some perspective, when I was a kid, My grandfather would give us bags of silver coins, quarters and dimes, and he would. I mean, it's total blasphemy religiously. He would hang them on the Christmas tree. He's from Italy, so the Christmas tree wasn't important to them. It wasn't symbolic. The nativity was, and the Christmas tree was like a German thing. So he would hang bags of silver coins on them for all of his grandchildren. So I've bought silver coins. I've been accumulating them for that reason, not to hang them off Christmas trees, but in a couple of years, when one of them says to me, I need money for books, I'm going to give him a couple silver coins, right? When one of them says I need money for a vacation, I'm going to give him a gold coin, or I want it to be a gold coin. It's like what a gold coin, like an ounce of gold buys you a good suit no matter what era of the world you're in. Well, how much is a vacation? 2 gold coins, 3 gold coins, 4, whatever it is, it should be the same amount 5 years from now. And that's why I'm buying coins for my retail, to teach my children a monetary lesson. And at the same time, I believe it. The bigger purchases have been and will continue to be in COMEX bars. So there you have it. Oh, by the way, do you have any stocks that I should be looking at on the mining side? I really have no clue what to look at anymore.
I'll tell you off air.
Wait, I should become a premium subscriber, right? If I'm not already, who knows? Okay,
yeah, I'm still recording. So on that note, Vince, thanks so much. I'll put out the links to all your work, and I really appreciate you taking the time to educate and inform us today.
You had me wired for sound because I'm very excited about metals right now. Even if the price doesn't reflect it, I don't care. I'm right. Like, I don't need to see the house burning down. I see the smoke. I saw the match thrown. I see the smoke. I saw the gasoline in the other room. I'm not worried. The house is going to burn down. And I'm going to, it's a horrible euphemism, but the house is going to burn down. We're all going to make money from the house burning down. And you know what? Just go do something else. It's going to happen. It's metaphysically going to happen. And if age is an issue for you, believe me, it takes more than 10 years, well, it's legacy for my kids. But if I need the money, I won't put it into precious metals for that reason. It's going to happen.
Thank you for tuning into the Daily Gold Podcast. For more interviews, editorials, and analysis, log on to TheDailyGold.com. And for premium coverage of precious metals and the best junior mining companies, visit TheDailyGold.com/premium.